Before we begin, here's how to earn continuing professional education credit for attending this session. Gain valuable insights by attending the podcast, then complete the assessment test to download your certificate. To do this, follow these simple steps. Click on the link in your description to access the session. Create a free account and attend the podcast. After the podcast, take the assessment test and download your certificate. It's easy, and it's free. We highly recommend checking out our subscription.
All right, got it. Now you helped clients save millions in US tax through transfer pricing. So for argument's sake, right, can you just walk us through like a high level example of what a smart strategy in this space could actually deliver?
Yeah, I mean every industry, every business is a little bit different, and you'll see, trends maybe within different sectors and things. But in general, a lot of what we do is what I just call like smart transfer pricing, right? Kind of aligning a company's, economics with its tax profile, because a lot of times they're really not in alignment where they should be. So when we look at where intellectual property is, or where services are being performed, or where customers are, in many cases they're all very, very different. So we're
Right.
looking at, okay, where is the value being driven within this organization? And is it also appropriately being, compensated for, priced in? And a lot of those things aren't really showing up in the financials as they are. There's a lot of services being performed within the group or something that are not being charged for when maybe they should be. So coming up with these, respective charges, within the bounds of the regulations of the various countries can really, really help you move money around in a not only tax efficient way, but, just cash flow efficient way as well.
All right. That makes sense. Now, like just adding a little bit more onto that because, a lot of people may have heard of transfer pricing, but then a lot of firms are thinking that, this doesn't apply to us.
Yeah.
So, like when does transfer pricing actually start to matter for firms?
hmm hmm
Hey everyone, and welcome back to another episode of We're Trying to Figure Out. I'm your host Saul, and today we are diving into the world of transfer pricing. Now, I know it may sound like one of those tax concepts only a global CFO would care about, but stick with us because understanding how profits are shifted, taxed, or shielded around the world, that's the $1 trillion chessboard multinational corporates are playing on. And one guy who's been helping them play smarter is my guest today. Carl Budenski, who is the tax partner and transfer pricing leader at Aprio. Carl has saved millions in tax through strategic planning and has been at the forefront of navigating two very significant regulations related to transfer pricing, the IRS, OECD. So today we're going to be time traveling a little bit, breaking down what's coming with the OECD Pillar 2, which is already effective January 2026, and help companies figure out what they should be doing. So, Carl, welcome to the show.
Thanks so much for having me, Saul. Yeah, I'm excited to be here. That's for sure.
Absolutely. The pleasure's all mine. Now, let's start in the present, Carl. Why does transfer pricing matter so much for global companies today?
Right. Yeah. I mean, I'm a little biased, but transfer pricing in my mind kind of determines everything in terms of a business going forward, at least a multinational one, right? So the concept of transfer pricing itself, it is where, you're determining the profits are taxed in what jurisdiction. But even
Yeah.
small pricing decisions, between related entities or related legal entities can materially shift the taxable income across, different jurisdictions, affecting overall tax rate, but also very, very important things to CFOs such as cash flow, as well as, any kind of audit exposure, reputational risk even. So in many cases, we think of transfer pricing as a compliance item, but it's
Yeah.
also very much a strategic business lever as well that most clients, don't always think about as, this truly powerful international tax planning tool.
All right, got it. Now you helped clients save millions in US tax through transfer pricing. So for argument's sake, right, can you just walk us through like a high level example of what a smart strategy in this space could actually deliver?
Yeah, I mean every industry, every business is a little bit different, and you'll see, trends maybe within different sectors and things. But in general, a lot of what we do is what I just call like smart transfer pricing, right? Kind of aligning a company's, economics with its tax profile. Because a lot of times they're really not in alignment where they should be. So when we look at where intellectual property is, or where services are being performed, or where customers are, in many cases they're all very, very different. So we're
Right.
looking at, okay, where is the value being driven within this organization? And is it also appropriately being, compensated for, priced in? And a lot of those things aren't really showing up in the financials as they are. There's a lot of services being performed within the group or something that are not being charged for when maybe they should be. So coming up with these, respective charges, within the bounds of the regulations of the various countries can really, really help you move money around in a not only tax efficient way, but just cash flow efficient way as well.
All right. That makes sense. Now, like just adding a little bit more onto that because, a lot of people may have heard of transfer pricing, but then a lot of firms are thinking that, this doesn't apply to us.
Yeah.
So, so, like when does transfer pricing actually start to matter for firms?
hmm hmm Yeah. So the kind of two answers, right? That from a compliance standpoint,
Right.
the U.S. regulations don't have any kind of de minimis threshold. So a dollar of intercompany cross-border activity is going to be reported on their tax return that would, thus trigger transfer pricing requirements. Now, in practice, uh, there's probably larger sums of money at play that this becomes more material. But, what I've seen is a lot of times clients or maybe other CPAs, they think, well, this isn't a large transaction volume. There's not a lot of transfer pricing risk there. And that might be true. Um, but at the same time, maybe it should be larger, right? You might be charging for one service when you really are providing five. Now the risk becomes quite a bit bigger because you're essentially undercharging, right? So in many cases, the profit margins of these different companies could materially change quite quickly if you do, a full kind of functional analysis of the business and the appropriate transfer pricing planning. Um, and even if it doesn't, reduce or increase or, put risk aside for a second, it again might just have really good cash flow alignment for your business, and the tax aspect of it might be negligible or change very little on a consolidated basis, but you might be getting money into places that before you were having a difficult time funding. So there's so many different things that come into transfer pricing strategies that do matter to a company regardless of the size.
Interesting. Now let's time travel a little bit, right? Let's jump into the history because I was surprised, when I listened to that other podcast of yours. I was surprised to learn that transfer pricing roots go all the way back to World War I, and I was like, whoa, I never really thought
hmm
of that. But like, so what are these? What were the early signs that led to transfer pricing becoming a global issue?
Yeah. Yeah, I'll have to kind of restrain myself a little bit because if I get too excited, we'll take up the entire slot here just talking about history. I think I'm kind of a transfer pricing history buff, but I won't get too deep into the weeds. Essentially, it's a lot of the same issues that we deal with now
Yeah.
from a political standpoint, right? Is when a country needs money, they look to alternative sources. So, the very, very first um seeds of transfer pricing. It's really not full transfer pricing, but seeds were planted back in what's called the War and Revenue Act of 1917. So it's looking at basically the first concept of like consolidated tax returns. So the 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 government at that point felt that there was individual companies that maybe should be consolidated under one return, and that would, prevent some manipulation, I guess, of the taxable income um, as a consolidated group, I suppose.
Right.
Now that was kind of all of the 1920s where they were tweaking that concept of consolidated tax returns, I suppose, for related parties. But in the 1930s, then we start to see real, I don't know, if we were at the seeds, now we're kind of at the roots of transfer pricing in terms of defining what's now known as the arm's length standard today. There's even a lot of that language that kind of crept into believe it was Section 45 at the time. Now it's obviously Section 42, but kind of discussion of arm's length standard and much of that language is still in play.
All right. All right. Now, like I'm not the expert on the tax codes or anything, but you know, you are. So let's talk about how the US tax code has evolved, particularly
Mhm.
with the section that you just mentioned. I think section 482, you said.
Yes. hmm
So
hmm
what made that such a foundational moment?
Right. Yeah, so that is the first time where we really have the concept of transfer pricing come into play, meaning it really gave that code section really gave the IRS broad authority to essentially reallocate income to
Hmm.
clearly reflect where they feel it should be lying, right?
Right.
Um, so, over time, the US continued to tweak these rules, very much driven off of what they feel is perceived abuse, but they continue to tweak and adopt and um, really refine some of these transfer pricing frameworks. I mean, even eventually getting down to specific methods for defining the transfer pricing. Now, if you follow kind of the timeline, you plot it against these pieces of legislation where this is doing that, it all comes at different times. So there's pretty big underlying shifts in the economy, and where there is again perceived abuse, or they think that there is essentially taxable income leaving the U.S.
Right.
And that's when new kind of rules need to be more restrictive, more defined, um, and it's all with the intention of giving the IRS more power to reallocate income to to the U.S. tax net. I
Hmm.
think the best example of this probably is like if you're looking at like the 1990s, for example, we're having huge shifts in the US and global economies in the way companies are doing business, like very much more globalized sectors like pharmaceuticals and technology. They're engaging in more intangible transactions, which are much more opaque, right? So the IRS and Treasury has to come up with more rules, and they just use this as the catalyst to revamp these transfer pricing rules to again capture more income.
Do you want to earn CPE credit? Take this course of MyCPE 1 to earn free credit. Click the link in the description to get started.
Interesting. But I wish, world would have been much better if it all there was just the IRS that was talking about it. But now we also have the OECD,
Yes.
and before I even talk about the frameworks, because that's very complicated topic. But before that, at what point between all this, at what point did OECD step in and start offering a different approach to transfer
hmm
pricing?
Yeah, so the OECD is an international body. It's based in France, but they really function as more kind of a nonprofit
Hmm.
organization focused on kind of building better policies for the world, and they do other things besides tax, many other
Yeah.
things actually.
Yeah. Yes. Yeah.
But that organization, it was actually established much later, obviously, than some of the things we're talking about in the 1960s. It's kind of a
Hmm.
predecessor to other international organizations like, the League of Nations and kind of
Yeah.
complementary to the UN. But
Hmm.
this international body, they rose to prominence a bit more in the 1980s when they came out with their kind of base erosion profit shifting plan,
Yes.
multilateral, um, tax uh, discussions. And they really do focus primarily more on like developing countries, right? Obviously, we think of it as like a more maybe like European
Yeah.
organization, but they're really there to come up with more coordinated, organized set of principles and standardization that could be adopted, especially for countries that, they don't have these resources where they can write their own tax codes and have, teams of economists and things for transfer pricing purposes. This allows countries, and there's many of them, right, that just adopt these OECD guidelines for transfer pricing as their own regulation, and that just immediately offers a lot of global standardization, a lot of certainty for companies that are operating, cross border, and that's
Right.
really the goal of the OECD. So they came out with that around that time frame, in the 1980s, and it was a totally different mindset in terms of the IRS, of course, just given the nature of its task, is focused on revenue collection and revenue generation for the U.S. and
True.
enforcing the rules and coming up with rules to protect its tax base. Now, the OECD is basically none of those requirements. They can't compel anyone to do anything, but they're like, hey, we're going to offer you a set of principles you can adopt, and it will give your country the benefit, I guess, of being kind of standardized with the rest of the framework. So that's where they started to rise to prominence, and then eventually they don't necessarily rely on that political funding where they didn't have those kind of holdups and cuts
Yeah.
and things like that, and they become a little bit more forward looking and can release more
Yeah.
guidance than
Yeah.
your IRS can.
Yeah. True. 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 Absolutely. I mean, their approach is pretty global. Uh, I mean, intergovernmental, coordination across nations, across borders. So that's really nice. Now, for those of you who are still wondering if, because there could be a lot of folks who could be probably just listening in for the sake of understanding what this is all about. So
Hmm.
OECD is the Organization of Economic Cooperation and Development,
Hmm.
and IRS, everybody knows what's IRS. So I mean, like now we got these two frameworks, IRS and OECD.
Yep.
So let's talk about what life really looks like for multinationals that are stuck between these two systems, which I'm pretty certain you get across this day in day out. So what are these some real world implications of trying to comply with both of them?
Yeah. Yeah, I mean the biggest difference being a lot of the methodologies and kind of thought process and frameworks I think are generally the same. There's I think we talk about it in the sense that there's more differences than similarities, but it's quite the opposite of that. It's really just the goals of the organizations are so different, right? Where the IRS is prioritizing enforceability in litigation and defense of its best interests of the U.S., whereas the OECD is prioritizing kind of cross-border coordination. So when we get down to the later section, you'll see like they're really trying to prioritize almost like a global tax system, which I don't think
Yeah,
will ever happen in completeness, right? And I don't think
yeah,
they probably do either. But
yeah,
that just reduces uncertainty for businesses and for countries, and I think it becomes a lot more collaborative, and that's ultimately the goal. But um, when you have these kind of overlapping type of interests or organizations, it does get confusing, right? One does have some items that the other does not have. That if you're operating in two different jurisdictions, um, it becomes duplicative in some of the things you're doing for compliance. You might have a methodology that facilitates that cross-border transaction between the two countries, and it might need tweaking on one side or the other, but you can only book it once, right?
yeah,
So
yeah,
there's just a lot of difficult kind of supporting documentation and discussion that needs to take place to ensure that what you're doing is going to be supportable if there was ever kind of scrutiny that occurred in one or the other.
hmm. Well, look, when there are if you are applicable, I mean, if the transfer pricing is applicable to you, then obviously you got the IRS, especially if you're a US corporation that has got a footprint across like pharmaceuticals, IT. Today, in
Hmm.
fact, the entire world is a global market. Even
Hmm.
small players could be having global footprints. So
Yeah.
have you ever seen a situation, maybe walk us through one, where a company had to make a tough choice or a trade-off between IRS and OECD standards?
Yeah, many times, right? And it goes back to what I said. At a bare minimum, we're probably going to see a tough situation where you need to come up with compliance documentation that's duplicative, right? And that just from a fee perspective alone is burdensome for clients, right? They're
Right.
paying for, two sets of documentation for the same transaction. So that alone is difficult. But one of the bigger discrepancies that we're seeing now is it surrounds the concept of like intellectual or intangible property ownership.
Right.
It's a very common tension point, and obviously each country wants to have kind of central or as much IP ownership as they can because it by nature would lead to more profit there, or the
True.
argument that more profit should be there,
Yeah.
or losses, I guess, but in this case, profit.
Yeah.
Um, And there's this concept of DEMPI, which is basically a set of kind of functions or principles that would be expected of an IP owner to undertake.
Yeah.
And it's also created this concept of kind of economic ownership versus legal ownership of IP. Obviously, the older way of thinking is just legal ownership. You have a contract or a registration of this IP, you're the owner. Well,
True.
in many cases, we see, across a global organization, functions like development or legal protection or exploitation of that. I'm just naming the DEMPI principles, right? But we see those functions not occurring from the standpoint of the IP owner. They're occurring
Right.
elsewhere. So
Yes.
now some of the new way of thinking, and it's is codified in some countries' tax codes and not others, is they're looking at this concept of economic ownership. So they think they actually own the IP. They're actually performing all these functions,
Yes.
and the weight of some of these contracts is now is becoming less and less.
Wow.
And so you have countries kind of essentially fighting over the same sets of IP,
Nice.
as a result of trying to find more profit as a result of that IP. Um, and so we still really, really emphasize having legal contracts, of course, but it's also now more documentation than just the contracts. It's, transfer pricing studies. It's looking at the functional like footprint of the organization, where headcount is, what they're doing there. So you have a much more robust argument and can present that argument saying, hey, this is where our IP is. This is where all these important functions on behalf of that IP are taking place, and here's how they're
Yeah.
compensated for. So it
Nice.
all kind of comes full circle, but it's just a lot heavier lift than maybe there was in the past when it comes
Yep.
to, the concept of IP ownership and
Yeah.
supporting that and the associated transfer pricing.
No, I agree to you. And believe me, as you were explaining, like it was able to make perfect sense to me. Though, transfer pricing does not apply to me, but I can resonate to it. I can completely understand why this is important and why this is also complicated in the same sense. So thank you. Thank you for laying that out to me, and to all our listeners as well. So, and with that, let's shift the gears to pillar two, which has kicked in globally in January 2026. So, plain English, what is pillar two and why is the tax world buzzing about it?
Yeah, it's kind of a loaded question because there's no simple version of putting it. It's a concept that says, okay, let's establish a 15% global minimum tax. If income
Yes.
is taxed below that rate in one country or another country, there can be a difference that's essentially collected. Now, in order to do that, it's very much it's very difficult. There's a lot of mechanisms. There's about, 4 to 5 different mechanisms within Pillar Two in order to achieve the global 15% minimum tax. I'm absolutely not going to talk about those because it becomes
Yeah. No.
not English, like a totally different language.
Yeah.
Um, but it's buzzing because we really found our new floor. Okay, there's not these low tax jurisdictions anymore, or at least none that are essentially respected. There's always going to be essentially a global minimum 15% tax, and that will be collected on a consolidated basis, or at least that's the idea of it. We
All
don't.
right.
It's going to say, hey, there's not going to be the Starbucks anymore of the world where there's a 4% effective tax rate. Now, is that going to come to reality? We can talk about that a little bit more because I had to add to my kind of script almost I prepared as of on Monday because of just some developments that I guess I'll talk about it in a couple minutes here,
Yeah.
about why Pillar Two is now a little bit more complex.
Access latest and trending CPE courses with my CPE One Unlimited Access subscription. Subscribe now.
All right, let's get to it then. So who's actually affected here? Is this only for the Googles and the Amazons of the world, or is there a ripple effect for smaller companies too?
Yeah, so the formal threshold is like 750 million euros in revenue.
Hmm.
So it's definitely a lot less than Google, right? There's a lot of
Yeah.
companies that would fall into that,
Yeah.
less than billion-dollar range.
Yes.
So it impacts a lot. The broader impacts though are much greater than that because it does change the audit and the legislation and kind of the expectations across the globe. There's obviously going to be a huge incentive um, for transfer pricing planning to still move profits to different jurisdictions, especially because Pillar Two is going to apply both kind of on a consolidated basis, but also country by country basis. So you still are incentivized, I guess, to move profits using transfer pricing before kind of Pillar Two calculations. And misalignment is still going to lead to audits and who's paying the applicable top-off taxes because the transfer pricing is directly influencing where the top-off taxes should be paid. So it's probably one of those instruments too that we've seen with a lot of tax where it starts off very high threshold and as it gets implemented, the thresholds slowly come down.
Yeah.
And more middle market companies, depending how you define that, are going to be pulled into that net eventually.
Nice. Nice. So this concept of a global minimum tax, right? So how does that interact with the transfer pricing strategy?
Right. So it's still going to kind of behoove taxpayers to have even more robust probably transfer pricing in place now
Hmm.
because maybe they're not essentially moving from, 12.5% to 37%. They're always going to be at 15% in theory. Um, but they're still going to want to move money within the organization and pay top off taxes in as few places as possible.
Yeah.
Because again, that's a very big cash flow suck if you have, you're paying foreign tax somewhere and you have losses elsewhere. So there's still room to optimize.
Yeah.
Um, and I guess the one thing that I want to mention too, before I, essentially run out of time, is there's been a huge development on Monday, actually. So,
Okay.
U.S. multinationals, they of course are expected to, be implicated in all this. I'm sure there's many, many multinational groups that for years since this has been released, been modeling out, effective tax rate increases by jurisdictions, reassessing their pricing structures
Hmm.
to kind of avoid inefficiencies. Well, there obviously was huge pushback when the Trump administration took over,
Hmm.
and they had come out and said that they will not be party to this at all.
Hmm.
And then they actually kind of notched a major win in the sense that they did secure a commitment from, international negotiators at the OECD to exempt U.S. multinationals from basically key provisions of the global minimum tax. Like they're like almost in a side-by-side arrangement, they call it actually, um, to really not be party to this. They kind of made the argument to carve them out from being party to this. They think the current U.S. tax structure does a good job of doing this already and that they were never going to kind of comply with any of the rules, that it was going to cause way too much burden for U.S. taxpayers, mostly because of, the largest companies in the world being in the U.S. and they were going to be the ones most subject to different
Yes.
top-off taxes like big tech and things in all the
Yeah.
different places where they operate.
All right. That's interesting. So would I be correct to say that, US multinationals who are already paying by the IRS rules, they are well positioned, or is Pillar 2 still going to be a curveball for them?
It's honestly a little hard to say now with like the recent developments, but just
Yeah.
a few days ago.
Yeah.
Um, I would say this is probably still a major victory.
Yeah.
It doesn't underscore the fact that like if you're a U.S. multinational, you're not necessarily like party to the global minimum tax, but you're still going to be operating in places where it applies. So how that side by side arrangement almost makes it more complex than having at least one kind of comprehensive arrangement. And then you're going to have these companies that are, they're still obviously large, huge public companies outside the US, elsewhere in the world that do a ton of business in the US. First one I could think of is like a Toyota, right? Like massive car company based in Japan. Well,
Yes.
are they going to be part of the global minimum tax? Yes, but probably their largest market in the world is the US. So they have
Yes.
to kind of still do all the same calculations and all the same balancing to determine what their footprint's going to be from a tax perspective and what this means to them. And by having almost two sets of systems, does this create a leg up for US companies? Maybe it doesn't. It's just a huge mess, really, in terms of you have potential standardization for some, but not all, and it definitely creates some more questions and answers.
Yeah, I'm sure they do. And now, like a question for all. I'm sure this is a question that all the CFOs and the tax leaders that are there on this podcast would be having in their mind. So I'm just going to ask on their behalf. So, what should the CFOs and the heads of tax actually be doing now to assess their exposure or readiness to these regulations?
Right. I mean, I would have hoped, by now that since it's kind of effective at this point, there's been, diagnostics and stress testing of transfer pricing models and kind of pillar two modelings that have been done. And I
Right.
think that's all needs to occur. Now
Hmm.
you have to layer in the additional, excuse me, side by side agreement aspect of it when it comes to US companies.
Yeah.
I would even encourage, tax directors and CFOs of those below the threshold to still kind of tune in and keep a pulse on what's going on, because it's not to say that this a similar type of concept couldn't apply on different thresholds or at different lower level companies. So I think it's definitely something that quite a bit of modeling needs to be done, talking to your advisors across the world, really, and get their input as well, because it's very, very hard to backpedal with these things. If you get hit with a tax bill you were unexpecting, or that was unexpected to you because you didn't do the proper planning, you more than likely will have to pay it and then and try to get it back later or fight for it.
Yeah.
So it's better to
Yeah.
be a little bit more prepared.
Yep, yep. And you kind of like subtly just answered what I was going to ask you, that if those who are under the threshold, should they still be ignoring it? But you kind of like just answered it, that you should
Yeah.
still be
I
checking
always
on.
say keep a pulse on these things because they tend to lower the thresholds over time.
Yeah,
They almost
yeah.
always do, or come up with something similar for more middle market companies. Plus
All
with,
right.
even with inflation, right? A $500 million company today, in a few years could very much fall within these, even if they don't lower the thresholds through just like basic growth and inflation alone. So I
Yeah.
think it's something to be prepared for.
Yep. 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 And are there like, I know like this can affect a lot of businesses and a lot many industries. You already spoke about pharma, technology. You also spoke about automobiles. So
hmm
I know there are too many industries in the world that could be affected, but for argument's sake,
hmm
are there any specific industries or business models that should be paying closer attention to this shift?
Yeah, I mean the intellectual property or the intangible property heavy industries.
Yeah,
Think anything digital, anything software,
yeah,
pharmaceutical would fall into that bucket.
mhm,
Social media, things like that, like the real big tech organizations,
yeah,
anything cloud, those are the industries that have spurred pretty much most of, tax policy and a lot of what the OECD has come out with recently.
yeah,
They've always spurred that, right? Because they're very hard to keep up with. They're by far the most dynamic, and they have just so much intangible aspects to them that are very hard to track. You can do business in as many countries as you want, like remotely in those types
mhm,
of industries in many times, in many ways. And that's kind of spurred this, right? So those industries are going to be the ones that are always going to be the most targeted, most affected. You've seen this before Pillar Two was basically the unilateral digital service taxes, just basically flat taxes on digital services as a way to try to, capture taxable income from big companies like Netflix or someone that essentially is doing business in your country and you can't even track it. So
mhm,
those are the ones, those type of operating models, any kind of operating model like that where you don't really have boots on the ground or a physical footprint, but can do substantial business.
Yeah.
those are the ones they're trying to go after because they don't they see you, but they want more insight and they want more scrutiny into you. So those are the ones I would definitely be cognizant of.
Wow. That's a lot of companies.
That is a lot of companies. It's more and more every day. Now you have AI thrown into the mix, and
Yes.
and more
Yeah.
100 AI companies pop up every day. This is going to be
Yeah.
targeting them exactly.
Oh my God. Oh my God. I'm not sure, whether OECD had, like seen the future and they knew that there's going to be AI companies in the future. So let's just get this out there. But
Hmm.
this is crazy. So, I want you to probably take out your crystal ball and, like give me a big picture. Do you really think we'll ever truly see a truly global transfer pricing standard, or is the dual standard world just how it's going to be?
I think we already have a very basic set of global transfer pricing principles. I think we've achieved that. We
Okay.
have specific methods that are almost universally kind of used. So that we've essentially achieved.
Okay.
Now, I think there will always be or there will always be incentives for countries to protect their tax base and to have a lot of unilateral measures of how they apply those concepts. And they're always going to fight for more taxable income. So is there ever going to be like a global apportionment, like global minimum tax that's paid on a perfectly proportioned basis? Probably not. Businesses are too creative for that.
Yeah.
What I do see is maybe kind of a future trend is more data analytics, more joint audits, excuse me, and more emphasis on, countries do actually working together to catch maybe larger tax, um, kind of scale base erosion, right? They're putting more emphasis on operational substance, um, and if they're able to share more data with one another, I think we could see some a lot more tightening up of tax policies for companies.
All right. All
Um,
right. That makes
yeah, and
sense.
so I mean, what this I think is going to by default lead to is that's going to force, companies that do want certainty and do operate in large global markets like in India or Brazil or something like that have historically been very difficult to do business in. I think
Mm-hmm.
it's going to force them to come to the table and say, hey, we want to do like an advanced pricing agreement. We want, a negotiated set, certain agreement with the governments of both countries that we won't be audited. Here's our policy. It's very, open, but at least we'll give them, forecast ability of their tax footprint in those places. I think that will happen more is that we'll see more of those APAs because countries will start working together.
Well, you kind of like just answered. I think, you got to let me in onto the crystal ball because, you even answered the next question that I was going to be asking you.
Oh,
But interesting, interesting. Now this has been eye-opening, Carl. So, I'm sure there's a lot that we could talk about, but, as we come towards wrapping this up, for folks who want to follow your work, because I'm pretty certain there is a lot of movement happening and it's going to continue to happen. You are always at the forefront of knowing everything that's happening. So, for those who want to get in touch with you or just stay ahead of this, where can they find you?
yeah, I mean, I'd be happy to answer any questions or follow-ups or let me know if you liked or disliked the podcast afterwards. You can always connect with me. I'm on LinkedIn at Carl Budenski. You
Yeah.
can find me at carl.budenski@aprio.com. I'm very active on LinkedIn and other platforms. Always very responsive with my emails. So if you want to pass a question off to me and say, hey, can I expect more documentation expectations in the future? I'm going to say yes, and I can help you. I'm going to
Absolutely.
say, all this nationalism is going to creep into our taxes, and we're probably going to see more foreign companies tax. So let me help you. Let me protect you. I'd be happy to also just nerd out to any historical transfer pricing questions you have.
All right, this is great. Well, folks, I am also going to be dropping Carl's LinkedIn in the show notes, so you have that handy. You already know his email, so I'm be sharing that in the show notes. I'll keep that private to all those people who are listening into this. But with that, I want to thank you all for joining in, and Carl, thank you so much for breaking it all down for us. All right.
My
Good luck.
pleasure. I could go on for a lot longer, so thank you for having me.
Absolutely. I mean, to be honest, this is one of those topics where the more you know, the more you realize you don't know.
Yeah, I would agree with you on that.
Yeah, yeah. And I'm glad that we had you to help us figure this out. So thank you so much once again. And to all the folks who are listening in, make sure to like, share, subscribe, let everybody else know. You know how to get in touch with Carl. So make sure to make best use of this. And with that, thank you all for your time. Until next time, take care and keep innovating in everything that you do. Cheers.
Access latest and trending CPE courses with my CPE One Unlimited Access subscription. Subscribe now.